Thank you guys for clicking on the video. Today's book summary is going to be on common stocks and uncommon profits. Now, a quick heads up, this book is heavily invested into fundamental trading and teaching you how to do it and his preferred method known as the scuttlebutt method. So first things first, the scuttlebutt method is basically 15 points he looks at when he's going to buy a stock. The first point being, does the company have products they can make sizable profits and market it? Now, when he talks about doing this, he also mentions that when you look at their balance sheet and their annual reports, you want to look at their yearly income to make sure there's an increase, and actually not just 1 year, but multiple years at a time to make sure that they're growing at least every 3 years. Number 2, does the management want to develop new products to grow over time? Basically saying that he wants them to make sure that they are always in the loop and always up to date in their sector and always trying to innovate. Point number 3 being, how effective is their research and development for their development size? Now this one's very interesting. Just because they're researching new products, it also depends how big their company is and how much money they're putting into their research. If they're a bigger company, you want them to be developing more products. If they're a smaller company, they can't generally put all their funds into that research, but you still need to have research and development to advance their company and their technology. Point number 4, how does the company have an above average sales organization? So you want to make sure that their staff in sales is one of the best people out there that can get them sales, because one of the leading factors in how profitable a company is how much they can actually sell their product. Point number 5, does the company have a worthwhile profit margin? You can't have too small of a profit margin or else the company's gonna have growing pains. Point number 6, what is the company doing to maintain that profit margin? As they grow, that profit margin becomes smaller and smaller, and so they're going to need to find a way to make it so that they can keep that profit margin. Point number 7, does the company have outstanding labor relationships? Meaning, do the people that work for this company like where they work and love their job, or do they hate it? If you have generally a happy staff, they'll take pride in their work and they'll do a better job. Rule number 8, does the company have an outstanding executive position relationship? Meaning, do the top executives at the job also enjoy their job? They're the ones taking the company in a new positive direction, so they're going to want to be made happy as well. Point number 9, does the company have a depth to its management? You can't just have one company have one manager and that's it. If you were to ever leave, or worse so, even die, you would need people to fill that position and take over and still be well trained. And even more so, you generally want to have multiple executives, not just one person. Point number 10, how good are companies' cost analysis and their accounting controls? Accounting is one of the biggest factors when running a company, and they need to have a great system put in place for that. Point number 11, is there anything special about the company compared to other companies? Meaning, do they have any patents that they have that other companies can't get, or anything that really sets them apart from the herd? Point number 12, does the company have a short-term or a long-term view? Meaning, is the company only in it for the small profits right now, or are they trying to build a long-lasting company that'll be there for a really, really long time? Point number 13, will the growth need financing to grow? Meaning, does the company actually need money to grow, or are they able to do this on their own? Point number 14, does the management talk to investors in both good and bad times? Meaning, does the executive both let the shareholders know about their situation and make them aware in both good and bad times, showing that they're not afraid to be open with their shareholders? And finally, point number 15 in the scuttlebutt method, does the company have management with integrity? You don't want any insider trading or anything suspicious going on inside your company. He goes to mention that typically investors only do half the work when trying to find growth stocks, and how young growth stocks, if you can find them earlier enough, provide the greatest gains. And with keeping that in mind, those companies should always have a surplus and an emergency fund inside left over in their company. He later talks about how the right stocks held long enough will always produce a profit, and that trying to time the market is a silly thing. If it's a good stock, you should buy it now. There's no point in waiting later. Even though, and I'll get to it later on in the book, he does explain this a little bit more in depth and how you can time it to get a better deal. But in this same chapter, he explains that the best companies are scientific technology companies, and that you should be well aware that there always will be some failure when picking the perfect stocks. And a great way to know if you have or haven't is there will be a 6 to 8 week shakedown period. So even if it is a great stock, there will be a little bit of time where it's going to test your patience and the stock won't truly reflect where you think it will be at the time of purchase. But after completing the scuttlebutt method, he explains when you should sell, and here are his 3 reasons why. Reason number 1, is kind of one of the most obvious is that a mistake was made when buying the stock, that you might have missed one point in this method and you made a purchase that you really shouldn't have. Reason number 2 to sell is they no longer meet the scuttle point guidelines. Some common factors that can be included in this when you have perfected this method and you picked a company that did the right thing is that now, after they've had a little bit of gain, that there is no longer a drive in the management to try to increase this company's size and worth, or that the growth that they've had in this company is exhausted. The market is really well consumed and exhausted, and they can't expand much further. They've hit their limit. And finally, rule number 3 when you should sell is when you found a better company to invest in, meaning your company has been doing great for you and they're starting to slow down, or they've exhausted all their resources, but they're still growing a little bit, but you found a new company that you can invest in and reallocate your money into a better position to work harder for you. In the same chapter, he mentions some of the common fears that people do sell when they really shouldn't, saying that a price is over too high on a stock, meaning they feel that the stock they've chosen has gone up a significant amount and is much more valued than it should be, even though more often than not the stock's going in that direction because it is a great stock. Another fear being that the so-called bear market rally is coming, or we're going to head into a bear market. It says it usually never happens, and it's really hard for people to predict the market. So if someone's predicting that there's a bear market coming, more often than not, it really isn't. And finally, one of the biggest major fears is the stock has just gone up to a huge amount, meaning in one day it dropped a nice 20% or so, or even 30% in a single day. When stocks typically do that, there might be a little bit of a pullback now because people are going to be taking in their profits, but stocks head up to higher highs for a reason. In the next chapter, he talks about how dividends can be good or they can be bad. They're bad if this company is paying out a dividend just to make the stock seem more lucrative than it really is, and they really should be taking that money and reinvesting it into the company. But paying out a dividend could also be bad if they have a ton of excess cash and they aren't making the company better. So they're paying out this dividend when they really should be reinvesting it. And they can be good if the company does have a little bit of excess cash and they can afford to pay out these dividends. And having no dividend could also be good if they're using this money to reinvest. And he then explains that dividends should only be raised with caution. In the next chapter, he gives you a few lists of don'ts. Don't buy into promotional campaigns, meaning young companies that are just freshly going onto the market. Don't ignore a good stock because it's traded on the OTC. Don't buy a stock because you like the tone of the annual report. Now, just to explain this one versus the other one, since it's not really as clear cut, he talks about how a CEO will give a great newsletter to shareholders, having it being written really, really well, and making it really hard to decipher if this company really is heading a good direction, since every newsletter sounds great, and that you shouldn't buy based off just what the CEO is saying, and that more often than not, he didn't even write it. A professional writer did. The fourth don't is to not assume that the high price at which a stock is selling in relation to its earnings is an indication to the growth, and those earnings were adjusted to the price. And here he's actually talking about the PE ratio. Just because the PE ratio is huge doesn't mean that the stock is overvalued in a sense. And finally, the fifth don't is don't quiver over ace and quarters. In the preceding chapter, he actually gives another list of don'ts. Don't stress over diversification, which is an interesting concept because every book actually explains how important diversification is. However, his method of investing picks only the best stocks, and that even if they are in the same industry, that holding these stocks for years and years to come will prove to give you suitable gains. The next don't is don't be afraid of buying stocks on a war scare. The third don't is don't forget your Gulvin and Sullivan. And what he means by this one, just to explain it, is don't buy stocks just because they're near their 5 or 10 year previous highs and lows. That technical analysis of the past based on charts isn't as important as the information that's presented now. The fourth don't is don't fail to consider time as well as price. And here's what I was talking about earlier. He explains how just because a stock is, let's say, $20 right now, when it should really only be trading at $15. But you know in about 5 years or so, this stock is going to be worth $75. So yes, technically buying it right now, you're overpaying for the stock just a little bit. In a few years, it'll be worth a lot more. However, you are losing a bit of money right now, and if a correction were to come, you would lose money for no apparent reason. And he says the best way to do this is to find some news and see when they're going to exact a new deal and to buy the stock 1 month before that to see if the correction comes along. And if it doesn't, buy the stock then no matter what. You do know it's going to be a good buy in the years to come. However, right now it may be overpriced, but a correction may never come and you don't want to lose on the stock. And his final don't follow the crowd. So I hope you guys liked the video. This is a very interesting book and that it was different than a lot of stock books in that it went into the extreme detail into analyzing companies. He even mentions how he would go into banks and businesses to interact with the people and just to see how well they work. The book is a little bit out of date in that he wants you to invest by talking to people, going in the store, talking to people on the street about it, calling them up, and even interviewing the people to see if they like the company or not, or where they think the company is headed, which are still great practices today. However, information is a lot harder to get on the inside since everything nowadays can be publicized and people are a lot more wary of what they say, especially to strangers. Either way, it was amazing to see how in depth you can take looking at a company's fundamentals and investing based off that alone. So I hope you guys liked the video. Remember to leave a like, comment, subscribe for more future content.